Good day everyone, thank you for joining me. I'm Tamara Kukshinovich and I'm going to take you through Intu's year-end results. Intu Properties focuses on the retail sector mainly in the UK. The group's loan-to-value ratio of 53% is above the group's target of 50% and well above peers. This has been impacted by the decline in valuations. To reduce debt, management has cut the dividend to zero and plans to retain cash in the short term. Since the UK REIT is required to pay 90% of taxable profits as dividends, there will be a UK corporation tax charge of 19% going forward, which is estimated to be between 15 and 20 million pounds. Further, disposals in the UK and Spain are on the radar. Management will focus on winning destinations capital expenditure, bringing partners into UK assets, exit smaller assets and potentially selling Spanish assets as they have received unsolicited offers. Given the excessive gearing, the dividend being cut to zero and a limited possibility of UK disposals at book value, we recommend an underweight position relative to the SA All Property Index. Net rental income decreased by 2.1% due to the partial disposal of Intu Chapel in January and the acquisition and partial disposal of Intu Xanadu. On a like-for-like basis, net rental income increased by 1% due to rent reviews and improved lettings and was partially offset by administrations and CVAs. Administration expenses increased by 5.8% due to higher corporate overheads and depreciation on IT capital projects. Net underlying finance costs decreased by 1%. Management have guided that finance costs in 2019 are expected to be approximately double the second half 2018 figure. The year-end dividend was cut to zero, resulting in a final dividend of 4.6 pence per share, which is a reduction of 67.1% from the previous year. Net asset value decreased by 24.9% to 283 pence per share, mainly due to the deficit on property revaluations, which had a negative impact of 102 pence per share. Net debt grew to £4.9 billion due to capital expenditure being offset by the proceeds received from the part disposal of Intu Chapel. The loan-to-value ratio increased to 53% due to the deficit property revaluation in the year. Management has revised their strategy and will be looking to reduce the ratio to below 50%. The weighted average debt to maturity decreased to 5.8 years, and the weighted average cost of gross debt remains stable at 4.2%. The interest cover slightly decreased to 1.9 times and remains above target. Cash and available facilities decreased to £550 million. In conclusion, we would recommend an underweight exposure relative to the SA All Property Index, which has a 1.7% weighting in the counter. If you would like to place a trade, please speak to your financial advisor or contact the dealing desk. A comprehensive company analysis report on Intu can be found on the PSG online trading platform. Before we end off, please take note of the following disclaimer. Thank you.